Very good morning, friends. First of all, I welcome you all to these classes. So today we're going to start with a very interesting and I would say a slightly technical topic as well, and that's called financial instruments. I think needless to mention the importance of this particular topic. If you look at financial instruments, I think it almost impacts, I would say, if I don't give a very accurate percentage, almost around, I would say, 75–80% items in the balance sheet of the company. So it's a very practical oriented topic as well. And at the same time, a very important topic from the examination point of view as well. Because invariably, if you look at the past trend in the examination, you would invariably see a practical question on financial instruments. Now, when we're looking at financial instruments, considering the complexities, these standard setters have actually, divided the standard into three standards. I think this is the only standard which is being, created in the form of three standards. Yes, you heard me correct. There are three standards which are devoted to the concept of financial instruments. One is Index 32, which talks about the presentation of financial instruments. Then there is Index 109, which talks about the financial instruments recognition and measurement. And then there is another standard, which is financial instrument disclosure, which is Index 107. So we've got a total of three standards to cover in this particular standard. So I think before I proceed further, I think the very first thing which I like to make a mention, let me share my board to you. And I guess let me first of all take you to a little input. So you can first of all make a very basic note that when we're looking at the standard financial instruments, as I said, financial instrument is covered by a total of three standards. So we've got, first of all, Index 32. And the name of Index 32 is supposed to be Financial Instruments Presentation. I think a little word before we go into any depth on these standards. Well, when you say financial instruments presentation from the point of view of a balance sheet. So when we're looking at the word presentation, you'll not see much accounting in this particular standard. Since the standard focuses on the presentation part, this presentation is going to be in the balance sheet of a company. Then there is a second standard, in which is Index 109. And Index 109 talks about, again, financial instruments, but it talks about recognition. It talks about recognition and it talks about measurement. Now, I think as you look at the word measurement, you can, of course, make a guess that measurement would mean that you're going to get some accounting as well in this particular case. So this standard is going to be talking purely in terms of accounting. So this is the core standard where we're going to discuss the accounting of financial instruments. Not that in Index 32, we're not going to talk in terms of accounting. In terms of Index 32, we're going to talk of the presentation, but a little accounting of certain instruments will also come. But the core area of accounting is going to be Index 109. And then I said there is another third standard, that is Index 107, and that talks about financial instruments disclosure. Naturally, when we're looking in terms of disclosure, naturally, we're not looking at any kind of accounting because all these disclosures are going to be made in terms of the notes to accounts. So you can well imagine the complexity involved in the standard, but I think complexity always creates an interesting situation as well. So in this particular case, when I'm going to take you to the standard, we're going to go in these particular parts. So we're going to go, first of all, discussing Index 32 with you. And after discussing Index 32 with you, then I'll move on to Index 109, followed by Index 107. Okay, so I think let's start the journey. And I think let's start first talking about Index 32, financial instruments. Now, of course, as I go on to the topic, I am not assuming that you've got any background regarding the concept. So I'm going to discuss the standard as if you're absolutely fresh to the standard. Any questions you want to ask in between, you're most welcome to ask. So we're going to maintain a little good pace, not a very fast, not a very slow pace, but we're going to build up the concept on a step-by-step basis. So let's begin the journey. Okay, now coming to the fact that when I am looking at the standard financial instrument, the very first question what comes to my mind is, what is a financial instrument? Whenever I look at any standard for that matter, I always first of all focus in terms of the name of the standard. So I think let's first of all begin with the definition that what is a financial instrument. So I'm going to share the study material with you. So this is the unit 1 of the study material. And in this case, we can see the definitions have been covered in unit number 1. So I'm coming to the definition which is given out here. Let me zoom it a little further so you can see it very well. Okay, so I think we can have a look at the definition now. It says a financial instrument is any contract. Now, first of all, a little caution, just read it with me, nothing extra, nothing less. We're going to focus on certain inputs and I'm going to give you interpretations on certain area. So it says a financial instrument is any contract. Don't read further. I'm focusing on the word that it is any contract. Now, when we say that there is a contract, we know a contract will always consist of a minimum of 2 parties. So the very first question what comes to the mind is that when you're looking at financial instrument being a contract, which are these 2 parties? So I think let's understand the 2 parties in a contract. So I am just going to take a very basic example to understand this. Let's say, for example, we've got a company XYZ Limited, and the company XYZ Limited, let's say, issues equity shares. Let's say it issues equity shares. So in this particular case, somebody would definitely subscribe for these shares as well. So let's say, for example, that the shares issued by XYZ is subscribed by, that means another company makes an investment, and let's say ABC Limited makes an investment in these particular shares. Now, when you say that XYZ Limited issues these particular shares, then we're going to call it as an issuer. Not issuer, we're going to call this as an issuer. And ABC is what is going to be called as a holder. Since school days, you've always been saying shareholder. You've always been saying debenture holder. So basically, the company which makes an investment is what we can say is called the holder. And the company XYZ is what we can say is supposed to be the issuer. So in terms of the financial instrument, one thing is very clear, that there will be 2 parties involved in the contract because it's a contract. So there will be 2 parties in the contract. Now, hear me very well. Now, when I say that company XYZ issues an instrument, naturally, this instrument is going to be represented on the liability side of the balance sheet. Now, you know that when you present things on the liability side of the balance sheet, the liability side of the balance sheet is nicknamed as equity and liability. And if you focus on the liability side of the balance sheet, it is called equity and liability. In simple words, we can say equity is supposed to be, you can say, own funds. When a company employs funds, you can say there are 2 kinds of funds. One is what you call an own funds. And when we say liability, liability is supposed to be what we call loan funds. So the issuer has to decide that when it presents, mind the words carefully, the issuer has to decide when it presents the instrument in the balance sheet that whether it is an own fund, that is equity instrument, or it is a loan fund, which is called a financial liability. Sir, you just said equity and liability. Now you've changed slightly the terms, equity instrument, and instead of liability, you're calling it as a financial liability. Don't worry. What is a financial liability or what is an equity instrument? We will very shortly get into these details. But I think let's first of all understand that the problem which is confronted by XYZ, or I would say the issue which he confronts is that as an issuer, is he supposed to reflect this instrument as an own fund that is called equity instrument, or is he supposed to reflect the fund as a loan fund which is called a financial liability? So he faces an accounting issue to classify, or I would say to present the instrument in the balance sheet of the company as a own fund or as a loan funds. Now, as far as the holder is concerned, there is ABC in my given example. The company ABC is only going to show it on the asset side of the balance sheet. And when you reflect things on the asset side of the balance sheet, we don't need to decide anything. Because in terms of assets, you only decide between the current and the non-current, and you decide in terms of financial or non-financial. So he is only going to call this as a financial asset. He's going to call this as a financial asset. Okay, so I think one thing is pretty clear in my mind now. And I think let's recollect what we've learned. So we can say when a company issues an instrument, the party is called an issuer, and the other party who makes an investment is called the holder. So there are two parties in a financial instrument. One is the issuer of the instrument, and one is the holder of the instrument. So the company, the entity which issues the instrument, has to decide its presentation on the liability side of the balance sheet. It needs to take a call whether it's an own fund called an equity instrument or it is a loan fund that is called a financial liability. He needs to take a decision. He needs to look at the contract and decide that is it an equity instrument or is it a financial liability. But as far as the holder is concerned, he would always land up saying it's a financial asset, which means, I guess, if I want to elaborate this further, we can say that if I look at things from the point of view of the issuer, and if I look at things from the point of view of the holder, so we can have two permutation combinations which could arise. The issuer says that it is an equity instrument. Now, we don't know what is an equity instrument at the moment, no worry. The holder would say it's a financial asset. The second permutation combination is the issuer says it's a financial liability. The holder would still say it's a financial asset. So the accounting issue is confronted from the issuer point of view because he needs to take a decision whether it's a liability or whether it's an equity. The holder would always land up saying financial asset, financial asset. So I think let me clarify one thing very clear at this stage. As I'm dealing in terms of Index 32, to begin with, my focus is going to be totally on the issuer. I'm going to focus totally in terms of the issuer. We're going to look at the fact that when an instrument is issued, what does he call this as? So I'm not focusing on the holder at the moment. Our focus is going to be only from the issuer point of view. I hope I've made myself very clear so far. Okay, I think let me just come back to the definition now. Having understood the concept of a contract, which is a contract between the two parties, so now let's, I think, come back and read the definition. It says a financial instrument is any contract that gives rise to a financial asset for one entity. Now, when I say it gives rise to a financial asset for one entity, I think needless to mention that that entity is the holder. And it says a financial liability or equity instrument for another entity. I think needless to mention that the other entity is supposed to be the issuer. So when you look at a financial instrument, it's a contract between the two parties, an issuer and a holder. The issuer needs to take a call, it's financial liability or equity instrument. The holder would say financial asset in both the situation. Now, I think having read the definition, one thing is pretty clear, that if I want to understand the definition absolutely clear, there are a total of three terms which needs attention. One is financial asset, one is financial liability, and one is equity instrument. Now, since I'm focusing from the issuer perspective to begin with, I'm going to focus on financial liability. I'm going to focus on equity instrument. Later, we're going to come to the financial asset. So let's now understand the three terms one by one. We're going to understand a financial liability, we're going to understand equity instrument, and then we're going to understand the financial asset. Okay. So for this purpose, I am now going to take you to the definition of a financial liability. So I am on the study material unit number 1. So if you have that with you, you can just come to the page number 12.10, where we are given the definition of a financial liability. Now, as I read, my piece of advice would be that please only read what I read, nothing extra, nothing less, because the definition is quite huge and slightly technical as well. So we're going to crack this definition on a step-by-step basis. So as you can see, the definition begins out here, and you can see the definition continues out here. So it's a pretty long definition, almost a one-pager definition, but we're going to go step by step. Now, what I am going to do with you, I am going to create this definition and convert this into a 3-step model. So we're going to go step by step, and I'm going to convert this definition to begin with into a 3-step model. So when I'm going to dig into this definition, I'll give you my 3-step model, which is the exposure draft 1. You heard me correct. I'm going to give you the definition in a 3-step model, which will be an exposure draft 1. I'm going to change that, and I'm going to give you an exposure draft 2 as well. After some time, I'll keep making some additions, and then I'll give you the final version. So I'm going to create my 3-step model into stage by stage. I'll give you the exposure draft 1, then I'm going to mutate it, and I'm going to give you an exposure draft 2, and then I'm going to give you the final draft after some time. So we'll keep making some additions. So we'll first understand the nitty-gritties at the first stage, give you the first draft, then we'll proceed further. So no worries on the notes. As I'll explain, I'll give you the notes also later. So don't worry that you need to pen down the notes. I will definitely write the notes down after the explanation is done. So let me, I think, begin with the journey. Let's read the definition. The definition says a financial liability is any liability that is a contractual obligation. That is my step number 1. You need to ask yourself, number 1, is it a contractual obligation? You need to first of all put across a question to yourself that is there a contractual obligation? Now, I think I would like to give you a clarification at this end. Let me just come back to the board and give you a little inputs. When you look at an obligation, I guess if you've done Index 37, you know that when you look at an obligation, the obligation can be of various types, and there are majorly 2 kinds of obligation. One is legal, and one is supposed to be constructive obligation. So if you look at the inputs which are given in Index 37, it talks about that there are 2 kinds of obligation. One is legal and one is constructive in nature. Now, when I say legal obligation, there are 2 types again. One is obligation by virtue of law, and one is an obligation which is by virtue of a contract. Now let's get this very clear, that when I am looking at obligation in Index 32, we are looking at only this obligation, which is contract. We're not saying it's a legal obligation, mind you. I think one thing you can very well see, that when I say a legal obligation, it can be by law or it can be by contract. But when I say a contractual obligation, it's just a portion of the legal obligation. So I think to put it like this, hear this carefully, I would put it like this. Can I say every contractual obligation is legal? Mind it carefully. Every contractual obligation is legal, but every legal obligation may not be contractual. I hope you get the point. Because when you say it's a legal obligation, it can be by virtue of law or it can be contract. So when I'm focusing in terms of financial instrument as a standard, the focus is on a contractual obligation. When 2 parties enter into a contract, then it creates a contractual right for one person and it creates a contractual obligation for another person. So we are looking at the obligation which is contractual in nature. So when you're looking at this index, remember very clear, I'm not looking at obligation by virtue of law. I'm not looking at obligation which is constructive. The focus is only contract, only contract. I hope I made myself very clear. So if I look at the definition, it very clearly says a contractual obligation. So the very first question which you're going to put across to yourself is that is there an obligation which is contractual in nature? If you say yes, you go to the step number 2. But if you say no, then this standard is not applicable. No worries, notes will be written later. Let's first get the concept very clear. So the very first question which you need to put across is that is there an obligation which is contractual in nature? So can you give an example of an obligation which may not be contractual in nature? Yes, there we come. Imagine a company has got an obligation to pay taxes to the government. So is this obligation something which is contractual in nature? No. You know, my obligation as an entity to pay taxes to the government is supposed to be, you can say, a statutory obligation. It is not a contractual obligation. So I would fail the very first step. So when you look at the obligation, what is important is contractual in nature. So payment of income taxes is a statutory obligation and not a contractual obligation. So can you give us an example, where it is a contractual obligation? Okay. Imagine a company made a sale of a product. So when you made a sale of a product, you also gave a warranty to the customer. So when you gave a warranty to the customer, is the company under a contractual obligation? Yes. I know what you're thinking. You are thinking, sir, if a company gives a warranty, that obligation is going to be covered under Index 37. Yes. But at the moment, in step number 1, it is certainly a contractual obligation. Now, maybe in step number 2 and 3, it gets eliminated. But if you ask me, apparently, if the company is made a sale and given a warranty to the customer, they've entered into a contract with the customer. So there is definitely a contractual obligation to pay. So these are the 2 examples. So I think I have made myself very clear on the step number 1 that you got to focus on the fact that is there an obligation which is contractual in nature? If you say yes, we go to the step number 2. If you say no, then the standard is not applicable. Okay, let's now move on further in the definition. I'm looking back on the definition and it says a contractual obligation A1, the clause A and the subclause 1 to deliver cash. Don't read further. Don't read further. It says a contractual obligation to deliver cash. Now comes my step number 2. In terms of step number 2, what I'm going to do, I'm going to look at what I call the mode of payment. I'm going to look at the concept of what is the mode of payment. So in this particular case, the mode of payment can be cash. Now, when I say cash, it is implied it is cash as well as check. So we're looking at the check also, and we're looking at the cash also. So it says a contractual obligation. It says to deliver cash. Then he says, I'm going to point number B. I'm going to point number B. A1, I'm not reading A2 at the moment. I'm going to point number B, the clause number B. It says a contract that will or may be settled in entities' own equity instruments. Now, this is something very interesting to, I think, understand. When we are looking at the mode of payment, the standard has given us basically 2 modes of payment. Please hear this very carefully. When you're looking at a contractual obligation, you want to settle that contractual obligation, and the standard has given us 2 modes of payment. One is that the mode of payment is cash. The other is that the company uses its own equity instruments, its own equity shares to settle an obligation. In other words, we can say the company uses its own equity share as a currency note. So I would use my own equity shares as a currency note to discharge the obligation. So can you expand that, please? Okay, let's do one thing. Let me just come back to my board and illustrate this a little further. Now, before we get deep into the step number 2, I think let's understand this a little further. Let's take an example, and I think let's get the insight in this. Now, imagine there is a company, or let's take an individual to understand the example, though we're going to talk in terms of companies, but I think let's talk in terms of individuals just for understanding, or maybe we can take a company, not a problem. Okay, let's consider there is a company XYZ Limited. Now, it approaches company ABC Limited. The company XYZ Limited approaches company ABC. Now, hear the deal very carefully. XYZ company approaches ABC Limited and it borrows, let's say, 10 lakh rupees. Company XYZ borrows 10 lakhs from company ABC. I am ignoring interest for convenience. Mind it carefully, let there be no confusion. I am ignoring interest for just convenience. So we are ignoring any interest on the deal. So this is a period, let's say the loan period in this case is, let's say, a period of 5 years. Let's say XYZ company tells company ABC that I'm going to repay this 10 lakh rupees to you after a period of 5 years. Now look at the possibility. Look at the possibility, how I'm working out. Now, hear this very carefully. The company XYZ tells ABC that I borrowed 5 lakh rupees, 10 lakh rupees from you today, and I'm going to repay this money after 5 years. I'm ignoring interest for practical convenience. So company XYZ borrows 10 lakh from ABC and tells company ABC that after 5 years, I'll pay you cash. Then I'll treat this as a financial liability. Now, you would also like to know the logic. Don't worry, the logics will come very soon. But I'm just going to give you, first of all, the input. Then we'll understand the logic as well, that why we are calling it as a financial liability. Now, the second option. XYZ company tells ABC that instead of giving you cash after 5 years, I will give you equity shares in my company. The company XYZ tells ABC that I will give you shares in my company, and see what he tells him. He says that I need to pay you 10 lakh rupees after 5 years. And he says my share as of today. Mind it, it says my share price as of today is 500 rupee. This is the price which is as of today. He says I need to give you 10 lakh rupees after 5 years. I'm dividing it by the price prevailing for my shares in the market today. So I will give you a total of 2,000 shares. He uses his own equity shares as a currency note, and he tells him that I'm going to give you a total of 2,000 shares. Pre-decided number. Mind it, it's a pre-decided number. So in this particular case, you must be thinking, why would ABC accept these shares? You would be thinking that today the price is 500. What happens if the price of the share goes down to 400 after 5 years? It would be a loss to ABC? Yes. But what happens that if the price of the share increases to 800 rupees per share, can I say ABC stands to gain? So it is a call which ABC would take, whether he is willing to accept the pre-decided number of shares or not. If he feels he wants to take that kind of risk, he may accept to take 2,000 shares, because he doesn't know the fate of the shares of company XYZ. You know, if after 5 years the prices will increase, ABC is in a gain situation. But if the prices will decrease, then he is under a loss-making situation. So in this particular case, it's completely a call of ABC that he may accept or he may not accept these shares. But if he decides to accept 2,000 shares, XYZ is going to call this as an equity instrument. So why? So why? Don't worry, I'll answer that why also very shortly. At the moment, let's accept the fact that if XYZ is going to issue a fixed number of shares, a predetermined number of share, I'm going to call this as an equity instrument. Why am I going to call this as an equity instrument? Don't worry, I'll give you the clarity very shortly. Let's take a third option now to understand it further. Now, the company XYZ tells company ABC that I will give you equity shares to settle this obligation. But this time he says that it is not technically correct that I divided by 500. It's not technically right that I divided by the price which is prevailing as of today. He says, okay, let me see what is the price which will prevail after 5 years. Let that be a good deal, a fair deal to you. So I will see the price which prevails after 5 years. If let's say the price after 5 years is 400, I will give you 2,500 shares. He says, I will look at the price which prevails after the end of 5 years, and accordingly, I will give you the number of shares. So he says, if the price of the share is 400, I'll give you 2,500 shares. He says, if the price of the share is, let's say, 500, I'll give you 2,000 shares. As many shares which will discharge the obligation of 10 lakh rupee, as many shares as would discharge the liability of 10 lakh rupee. So in this particular case, the number of shares is not fixed. It is not variable. It is variable. So we call this as a financial liability. Oh, so I guess we've understood one very important input. And what is that input? The mode of payment. Hear this very carefully. I'm looking at my step number 2. The mode of payment is either cash or the mode of payment is either equity share. So what is my step number 2 now? In the first step, you said that is there an obligation which is contractual in nature? I said yes. Then I went to step 2. Now in step number 2, what are you going to ask yourself? What is the mode of payment? Basically, there are 2 modes of payment, and you can consider them as an exhaustive mode of payments. For the time being, you're going to consider them as an exhaustive mode of payments. So when I say what is the mode of payment, it is either cash. If the mode of payment is cash, it's a financial liability. If the mode of payment is cash, it's a financial liability. If the mode of payment is equity shares, the company uses its own equity share as a currency note, you go to step 3, no hurry. Hurry could make a curry. So no hurry, you're going to go to the step number 3, and in step number 3, we're going to conduct what we call the fixed test. In step number 3, we're going to technically conduct a fixed test. Sir, is this fixed test something which you've given a nickname? No. I have not given this a nickname. This nickname has been given by the standard setters themselves. They've said that if a company uses equity share as a currency note to settle an obligation, you need to conduct a fixed test. Is the number of equity shares issued fixed in number, predetermined in number, like my point number 2, then it is an equity instrument. And if the number of equity share is supposed to be variable in number, that means it is not fixed, then it is called a financial liability. Sir, we understood the concept, but I guess we understood the step. But what about the logic? Why are you saying that if it is fixed share, then it is equity instrument, and if it is variable share, it's a financial liability? No worry, we're now going to get you the logic as well. But I think before that, it's important that we document these steps to you. So this is my first draft. I call it as my exposure draft on the 3-step model on the definition of financial liability. So I think let's start writing this down. So I'm going to create a 3-step model. And I think just on a safe side, let me call this as my draft 1. So that later we're going to change this draft. So this is my draft 1. So this is my 3-step model, which I am creating on the definition of financial liability. Okay, so let's begin step by step, and please do note it down. So this is going to be very easy in order to crack down questions. We're going to start with the basics, and of course, we're going to go to the advanced level of things. So the step number one, which you're going to put across is that is there a contractual obligation? The first question you're going to put across is that is there a contractual obligation? Please underline the word contractual. And I think I've already made myself clear that the obligation is not constructive. The obligation is not legal. It is contractual. So I think let's do one thing. Let me also highlight this particular fact for clarity. So when I say it is contractual, we are saying it is not legal. We are saying that it is not constructive in nature. So I think just for clarity of thought, we're just putting it very clear that it's a contractual obligation. It's not legal. It's not constructive. So the moment you say that it is supposed to be a contractual obligation, so you get the answer yes, or you get the answer no. Now, if you say that the answer is yes, you need to go to the step number 2. Don't worry, I'll take examples to make a run through with you very soon after my 3 steps get done. And if you say no, then we can say that this standard is not applicable. If there is obligation which is not contractual in nature, then I am not covered under the purview of this standard. That is my step number 1. Let's go to the step number 2. Now, the focus in terms of the step number 2 is going to be, we're going to look at what I call the mode of payment. Because if there is an obligation, you need to now evaluate that what is the mode of payment through which this obligation will be discharged. So let me call this as MOP, that is the mode of payment. But let me caution one thing, friends, at this stage. Because many people at times feel that if it is a step-by-step basis, it becomes a rule-based accounting. No, 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 no. If I am giving you a step-by-step, that doesn't make it a rule-based accounting. We know that the Indian accounting standard is, of course, largely principle-based. Now, when you're thinking within the step, there is a lot of inputs and a lot of principles being applied. So creating a step-by-step model is just for ease of convenience. But when you're going to look at these application of these steps, of course, we are applying certain principles in this case. Okay, so as I said, the mode of payment generally is going to be only 2. So you can say more or less this is like an exhaustive mode of payment. So either the payment is made in the form of cash or the payment is made in the form of equity shares. The company uses its own equity share as a currency note. So when I say equity shares, the standard allows me that the company is using its own equity shares as a currency note. Let me make it mention out here. So this is using them as currency note, using them as currency notes. So we're going to use them as currency notes for the purpose. That means the company could either use cash as a medium of settlement, or the company could use its own equity share as a currency note to settle the obligation. Now, in a situation where you say that the mode of payment is cash, we're going to call it as financial liability. So logic, don't worry, the logic is going to come soon. Let me finish with the steps, then I'll give you the logic also why it is called financial liability. And if you say that the mode of payment is equity shares, then I'm going to go to the step number 3. Isn't that pretty easy? So we are looking at contractual obligation, step 1. We're looking at the mode of payment, step 2. Now let's have a look at the step number 3. So let me take you now to the step number 3. And when you come to the step number 3, where you're looking in terms of the mode of payment being equity shares, you need to conduct what we technically call a fixed test. We need to conduct technically what we call a fixed test. Now, what is that fixed test? In this fixed test, you need to basically evaluate that number of equity shares being issued. The number of equity shares being issued, is it fixed in number or is it variable in number? So we need to look at the focus in terms of number of equity share. If the number of equity share is fixed, And if the number of equity share is variable, fixed means it's already predetermined. You've already decided at the time you issued an instrument that we are going to give a fixed number of equity shares in return at a later date. So if it is a fixed number, then it is called an equity instrument. And if it is a variable, then it is called a financial liability. Okay, so my first draft of my understanding of the definition of financial liability has been created. So I think let's now give you some logics that why it is a financial liability in terms of cash, why is it an equity instrument if it is fixed shares, and why is it a financial liability if it is variable share. I'll give you the inputs as well. But let's, I think, first quickly take a quick look at the three-step model. So as I said, we're going to apply a three-step model in order to understand that the definition of a financial liability, how do you decide that the instrument issued by the issuer is a financial liability or equity instrument? Step number one, is there a contractual obligation? The obligation needs to be contractual, not legal, not constructive. Then if you say a yes, you go to the step two. If you say no, it's the end of the story. In step number two, you need to look at the mode of payment. That when you're looking at the settlement of the obligation, are you going to make a payment in cash? Yes, then it is financial liability. If it is equity share, you go to the step number three. And in that case, you conduct what we call a fixed test. So when you're looking in terms of the fixed test, you need to see the number of equity shares which will be issued. If it is fixed, equity instrument. If it is variable, then it is supposed to be a financial liability. I believe so far so good. I hope you've been able to catch up with the concept so far. Let's take the journey forward now. Let's now understand the concept of why did these standard setters consider that fixed number is equity and variable number is financial liability. Let's understand this bit. I'm now going to take you out of this standard. In order to understand and appreciate, I think let's go back to the school days and let's understand the basics, what we learned in school out there. I remember that when we were in school, we were taught a concept when we were in school, when we started learning, accounting as a subject. We were given that there are two kinds of funds. One is called own funds and one is called a loan funds. What we technically today know that an own fund is supposed to be equity and a loan fund is supposed to be a liability. What we're calling it as a financial liability now. So there are two kinds of funds which are deployed by a company. One is called an own funds, which is equity, and one is called a loan fund, which is supposed to be a liability. Now, we were given that there are two parameters of evaluating whether it's an own fund or it's a loan fund. One of the parameters is the repayment of the principal amount. So one is the parameter that there is a repayment of a principal amount, and the other is the return which is given on the principal. So there are two elements which are considered in terms of distinguishing whether it's an own fund or whether it's a loan fund. Now, you would remember, we were given this concept in school itself that if you borrow funds and I have a contractual obligation to pay the principal back, and I have an obligation to pay the interest on that principal money as well. So a loan fund has got both the characteristics. It has got a characteristic of repayment of a principal, and it has got a characteristic in terms of making an interest payment on the same. So the company which issues the instrument, so a company which takes a loan has got an obligation to pay the principal. It's got an obligation to pay the interest on that principal. So there is a contractual obligation to repay the principal, and there is a contractual obligation to pay the return. Exactly, sir. But if it is a own funds, there is an absence of these obligations. If it is an own fund, there is an absence of these obligations. A company, an issuer, does not have an obligation to pay the principal. It does not have an obligation to pay any kind of dividends or any kind of returns on that particular instrument, correct? So that is what we learned in school, that a own fund is indicating absence of any obligations, and loan fund is the presence of an obligation to pay the principal and to pay the interest. Yes, sir. Now, I want you to look at the same thing. I want you to look at the same thing from the point of view of a risk perception. I want you to look at the same thing now from the perception of risk. So I want to look at the things from the perception of a risk factor now. Now imagine there is a company which issues a security. It issues, let's say, equity shares, and you say, I don't have an obligation to pay the principal. I don't have the obligation to pay any kind of returns on the instrument. Who is taking a risk? The question is, who is taking a risk? Is it the issuer or is it the holder who is taking a risk? So if my company issues an instrument and I tell the other person that I don't have an obligation to pay you principal, I don't have an obligation to pay you the return, then it is the risk of the holder. Exactly. The risk is indirectly taken by the holder. And if you look at a loan fund, then in this case, what am I telling the other person? That as an issuer, I have an obligation to pay the principal. I have an obligation to pay the interest even if I don't earn profits. So who is taking a risk? I would say it is the issuer who is actually taking a risk. The risk in this particular case is being taken by the issuer. So the other way of looking at the loan and own funds are, there is one way what we learned earlier, that you look at the presence of a contractual obligation to pay creates a loan fund, which means from a risk point of view, the issuer takes that risk. You treat the other person as an outsider and you tell him that I owe you the money, I owe you the principal, I owe you the interest on that principal. But if it is a own funds, you're telling the person that you are the owner of this company, you got to take a risk. I don't have any obligations to pay you. So if you look at things from the point of view of the risk factor, when you say that it's an own fund, the risk is of the holder. And when you say that it is a loan funds, then the risk is of the issuer. Now, I think let's get back and connect this out here. Now let's have a look in terms of the step number 2, and I think let's identify this with you. When you say that the mode of payment is cash, as an issuer, am I saying that I have a contractual obligation to pay this money? So as an issuer, I tell the other person that, okay, I'm going to pay your principal in cash. I'm going to pay the interest in cash. So the risk is taken by the issuer. So can I say if the risk is taken by the issuer, then in this particular case, it becomes a financial liability. I hope I'm making good sense and you're able to connect with the logic. So when the issuer undertakes a contractual obligation to pay a cash, then the risk is completely on the issuer. You're treating the other person as an outsider. If you're treating the other person as an outsider, then it is a liability for you. Then it becomes a financial liability because the risk in this case was on the issuer. Now let's have a look at the step number 3 and understand the logic of fixed test. Can I say when an issuer tells the holder that I will give you a fixed number of shares, I am pre-decided that I will give you a total of fixed number of shares at the moment. So am I passing on the risk to the holder? When you're telling the other party that I'm going to give you these many shares only, whether it goes up or down, it's your risk. So can I say the moment the risk is being shifted to the holder, can I say in this case, the risk is on the holder? And if the risk is on the holder, then it becomes an equity instrument. You're treating the other person as an owner. You're telling him that I will give you fixed number of shares, rest it's your gain, your loss. The price goes up, your gain. The price goes down, it's your loss. So the shift of that risk by giving him a fixed number of equity shares in the company is treating him as an owner of the company, treating him as an equity instrument holder. And I think if I say that you're going to issue a variable number of shares, you are taking a risk as an issuer. You are telling the other person that I will give you as many shares so that I discharge my contractual obligation to the extent of full. You don't have to take a risk. If the share price goes down, I'll give you more shares. If the share price goes down, I'll give you less shares. But I will give you as many shares so that the contractual obligation is discharged at my end. So who is indirectly taking the risk? The risk in this case is again being taken by the issuer. So every time you are deciding that why is it a financial liability or why is it an equity instrument, just think from the point of view of a risk factor. The moment you say that the risk is undertaken by the issuer, it becomes a financial liability. The moment you say the risk has been shifted to the holder, it becomes an equity instrument, right? I hope I made myself very clear on the logic. So, can we just have a quick consolidation of the concepts we've learned so far? Why not? So I think let me just now look at a quick look at my draft one, and maybe we can try some questions at this stage. Wow. So are we in a position to try some questions now at this stage? Yes. We'll try some questions also at this stage with the three-step model, but there's a lot more to go. And we're going to change this to draft two after adding some more inputs on this case. Okay, so let's, I think, consolidate the picture as we take further. So let me remind you, friends, at this stage that we are working on Ind AS 32. And in terms of Ind AS 32, the main call is from the point of view of the issuer. So when a company would issue an instrument, you need to first of all apply a three-step model to decide whether the instrument is own funds, that is equity instrument, or it is a loan fund, that is a financial liability. The step number one is to decide, is there a contractual obligation? So if you say no, there is no contractual obligation, we are not applying this standard. If you say yes, there is a contractual obligation, you go to the step number two. Now remember, the focus is on the word contractual obligation. That means it's not legal, it's not by law, it's not constructive where the company has accepted a responsibility on its own and you're creating an expectation. So it's not a constructive obligation, it's not a legal obligation. We're only looking in terms of contract. The contract leads to an obligation. Then we went to the step number two and we said, more or less, you could take this as an exhaustive mode of payment. You need to very carefully look at that. What is the mode of payment? Are you going to settle the obligation in cash, financial liability, because the risk is of the issuer? If the mode of payment is equity shares, you're using them as a currency node to settle the obligation. Time to go to the step number three. And in terms of the step number three, you need to consider the fixed test. You need to consider that the number of equity shares to be issued is fixed or variable in number. If the number of equity shares is predetermined, it is a fixed number, then it is equity instrument. Risk is on the holder. And if it is a variable number of equity share, then it is supposed to be a financial liability because the risk is on the issuer. Wow. Remember a little while back, I was talking about an example of a warranty. And I think you would definitely like to get a clarification because I said a warranty is a contractual obligation, but does it fit into this standard or not? Let's have a look. In step number one, now let's take the example. A company made a sale. A company made a sale and it gave a warranty to the customer. So you made a sale and you gave a warranty. Now I'm looking at this warranty. Is that warranty a contractual obligation? Yes. You entered into a contract with the customer where you said that I am having a contractual obligation towards you. I go to the step number two. What is the mode of payment in terms of warranty? Are you going to pay the warranty in cash? No, sir. Are you going to give him equity shares as a currency note? No, sir. What are you going to do in terms of warranty? You are going to give him goods and services. You will basically discharge your obligation by way of goods and service. If the mode of payment is goods and service, then this standard is not applicable. Now you got the point? So even though warranty is a contractual obligation, but it will fail the step number 2, because your mode of payment is supposed to be either cash, or the mode of payment is supposed to be either equity share if your mode of payment is by way of providing goods or services to the customer. It is outside the purview of the standard. In this particular case, if you're providing goods and services, you need to create a provision in the books of accounts, and you would technically apply Index 37 in this case. I hope I've made myself clear. Okay, I think now it's time that we apply this model to a little questions with you. So I'm going to take you to the study material, friends, and we're going to have a look at the questions with you. I am taking you to the unit number 3. I'm taking you to the unit number 3. So you can have a look at the study material, which is unit number 3. And I'm looking at page 12.102, and that is illustration number 15. This is the latest material on the website of the Institute. And we're looking at the illustration number 15, that is on page 12.102. Now, as I read this particular illustration, I know you must be bubbling with answers on that. So what I'm going to do, I'm going to just look at this illustration, but I'm going to apply my 3-step model in terms of answering this question. It says CBA issues convertible debenture. Now, when it says CBA issues convertible debentures to RQP, one thing is very clear, that CBA is the issuer, and it needs to decide that is it a financial liability or equity instrument. And RQP is supposed to be the holder. Holder would, of course, say a financial asset, but my focus is issuer. CBA issues convertible debenture for a subscription of 100 crores. Those debentures are convertible after 5 years into equity shares using a predetermined formula. Mind it, it's not a predetermined number, because many a times, we are very fast at reading the question, and we say, okay, predetermined formula. We were told in the class that if it is a predetermined, then it is supposed to be equity instrument. It's a predetermined formula, not a predetermined number, right? So we cannot say that it's a fixed number. It's a predetermined formula only. Now, I think let's have a look at that formula. In the numerator of the formula, we can see 100 crores is being multiplied with 1 plus 10% raised to power 5. Basically, we are compounding that 100 crores at the rate of 10% for a period of 5 years. So we can say that the numerator is supposed to be the principal compounded at the rate of 10% for a period of 5 years. So indirectly, it represents the total liability on 100 crores, inclusive of the interest. Then it is being divided by the fair value on the rate of conversion. When I say fair value on the rate of conversion, that means after 5 years. So when you're going to divide it by the fair value on the rate of conversion, can I say in this particular case, the number will vary? Because if the fair value on the rate of conversion is 500, you'll divide by 500. If the fair value on the rate of conversion is 400, you're going to divide it by 400. So the number of equity shares being variable in this particular case, we can say it becomes a financial liability. It's not an equity instrument. Because in this particular case, even though you're using your equity shares as a currency note to discharge the obligation, but since it's a variable number, it becomes a case of financial liability. But I think let's apply my 3-step model. I think if I just like to take you back on illustration 15 and apply my 3-step model and get my answers very clear. So let me just begin the journey. Let's, I think, take you on this. So we can say in this particular case, let's consider the illustration number 15, and that is on page 12.102. I'm looking at step number 1, step number 2, step number 3. So we're looking at the step number 1, that is Is there a contractual obligation of the issuer? Yes. You issued an instrument. So I would say, yes, there is a contractual obligation of the issuer. I go to the next one. I said, okay, what is the mode of payment? I said the mode of payment is equity shares. Then I went to the step number 3 and I applied my fixed test. And when I applied my fixed test, then in this particular case, we said the number of equity shares to be issued is variable in this case. Since the number of equity shares being issued is variable in this case, the conclusion is that it is a financial liability. So this is going to be reflected as a financial liability in the balance sheet of the company. Okay, I think it's now also important to link it a little with your balance sheet as well. I would also, add something at this particular stage. When you're looking at any standard for that matter, when you're studying the Indian accounting standard, it is very important on 2 parameters. One is that when you're looking at the standard, please link it with your Schedule 3. Because at the end of the day, you should not only know the accounting, but also the presentation which is there in the Schedule 3. So Schedule 3 Division 2 is something which you always take it as a base. Whenever you're looking at any standard, you should be able to directly connect that particular standard with the Schedule 3. And if possible, which of course I'm going to do this in this Ind AS, but right now, of course, it's a little early, I'm also going to connect you to a practical like balance sheet as well. I think it would be a good idea, that whatever you learned things, you're able to connect it with a practical like balance sheet as well. Because at the end of the day, being a part of the professional course, I think you're going to work in a practical life. So all these concepts, what you're learning is also going to be connected in a practical life. So don't worry, we're going to do that, of course, with you. But you should always make a little conscious effort in terms of understanding the topic and linking it to the Schedule 3 and linking it also to a practical like balance sheet as well. So a little linking would come later. Now, I think with this illustration 5, let's have a look at another illustration to you. Let's have a look at illustration number 16. It says DF issues convertible debentures to JL. So I think one thing is very clear, that DF is the issuer and JL is the holder. It says for a subscription of 100 crores. These debentures are convertible after 5 years into 15 crore equity shares of 10 each. I don't think so. I need to give you the answer. You would have easily reached a conclusion that they are convertible after 5 years into a pre-decided number. The company, the issuer DF, has already decided to give a fixed number of equity shares in order to settle the contractual obligation. Undoubtedly, it becomes an equity instrument in this case. But I think if I apply my 3-step model in terms of illustration 16 to make it very clear, it would go something like this. So on the same page number, I'm looking at illustration number 16. So my step number 1, step number 2, and step number 3. So in step number 1, we look at that is there a contractual obligation of the issuer? I would say yes, there is definitely a contractual obligation of the issuer. He must have entered into the contract and he's contractually obliged. What is the mode of payment in this case? The mode of payment in this case is again equity shares. The company is using the equity share as a currency note. And then we go to the fixed test in step number 3. And is the number already fixed? Yes, the number to be issued in this case is fixed. He's pre-decided the number of equity shares as 15 crore. So we can give a conclusion that this is supposed to be an equity instrument. Wow. So I hope I am pretty clear so far, so good in life, that I am now pretty clear on the concept that once you are looking at financial liability equity instrument, you got to apply this 3-step model. Okay. So now I think what I'm going to do, we're going to make some changes. As I said, that was my draft 1. I'm now going to work upon my draft number 2. So we're going to add a few things now at this particular stage. So let me take on further and let's, I think, add a few things now. Now, watch this carefully because I'm going to start digging in further in terms of certain inputs related to the step number one. I'm working on my step number one only, but now have a very careful look on what I'm about to tell you because this is going to open up more inputs to me. I'm now looking at my step number one. I'll first of all make a little changes to my step number one, and then I'm going to make some changes to my step number two as well. And then I'll give you a draft number two. So as I give you the draft number two, the draft number one will finish. So we're going to go on this draft number two. Then I'm going to make some more changes. Then I'll give you the final draft. And once I give you the final draft, we will be able to get a good hang on this standard. Now, please hear me very carefully. In step one, I said that there is a contractual obligation. In step number one, I said that there is a contractual obligation. Now my focus is on the word obligation. My focus is now on the word obligation. Now, when I say that there is an obligation, a little while back, if you remember when I was explaining the concept of own funds and the concept of loan funds, I said that in terms of loan funds, there is an obligation to pay the principal. There is an obligation to pay the return on that principal. So obligation has got two components. When I look at the concept of obligation, we can say obligation has got two components. The component number one is supposed to be the principal repayment. And the component number two is supposed to be the return element. The return in the sense, the return in the form of interest, the return in the form of dividends. So when I look at the concept of an obligation, you can say obligation has got two components. On a particular instrument which a company would issue, there is an obligation to pay the principal. There is an obligation to pay the return. Now, mind it carefully. If I were to ask you, is there a possibility that a company uses a different mode of payment to pay the principal, and a company uses a different mode of payment to pay the return? Yes, sir. The company may pay cash in order to pay the interest or dividends on the instrument, and the company may use, a payment equity shares as a mode of payment. So I think things can take a very interesting shape. So let me now tell you something very important. When you look at a particular question and you see that a company is using two different modes of payment, the principal payment is in a different mode and the return is in a different mode of payment, run my three-step model twice. Run my three-step model twice. Run it for the principal component separately and decide, is the principal component equity or liability? And run this, three-step model for the return component separately and decide, is it equity or liability? Sir, can you come again? I'm putting it again. Hear me very carefully. So what I am saying that the obligation on a particular contract can be of two components. There is an obligation to pay the principal. There is an obligation to pay the return on the instrument. So there are two components of your obligation. So when you say there are two components, a company may have a different mode of payment for the principal, let's say equity share. The company may have a different mode of payment to pay the return, let's say cash. So if you've got two different modes of payment, like for example, if you notice in illustration number, which I just did, I think I'd just like to take you back. If you look at the illustration number 15, you could see in the numerator, the principal and interest put together is being divided by the fair value of the shares, which is that both the principal and the interest is being paid by only one mode of payment, and that is shares. Even in terms of illustration number 16, the mode of payment is supposed to be common. There is only equity instruments which is being issued to discharge the principal and the interest element on the instrument. But now I'm changing your focus and I'm saying that, it is quite possible that one component is paid in a different mode, another component is paid in a different mode altogether. So if you see in a question that I am making a payment of principal, let's say in equity shares, and the payment of interest in cash, please apply my three-step model twice. Apply it for the principal component separately, apply for the interest component separately. So model of the story. So the model of the story in this particular case is that if you've got two components, and I'm putting it out here, if two different mode of payments, if two different mode of payments are there, so you have got two components and there are two different modes of payments are there, then run the three-step model. Then run this three-step model separately for each component. Run this three-step model separately for each component. That is an important thing to be kept in mind. So I'm going to apply this particular thing. I know what you're thinking now. Sir, if you're going to apply this three-step model in terms of the principal separately and for the return separately, sir, is it possible that one component turns out to be a financial liability and the other component turns out to be equity? Exactly. So then what do we do if one component is a financial liability and another component is an equity instrument? Then it is called a compound financial instrument. Wow. Then we're going to call it as a compound financial instrument. So moral of the story. You can have different permutation combinations arising by running this three-step model twice. You're going to get some few permutation combinations like this. If one component is a financial liability and the other component is also a financial liability, then overall the instrument becomes a financial liability. If one of the components is a financial liability and the other component is also a financial liability, then it's a financial liability. If one of the components is a financial liability and the other component is equity, we're going to call this as a CFI. This is called a compound financial instrument. When I say CFI, this is called a compound financial instrument. So let me put this is called a compound financial instrument. Sir, you mean to say that a issuer can technically issue three kind of instruments? Because when you started off this particular standard, you said it's either a financial liability or it is an equity instrument. Now you're saying it can be a compound financial instrument as well. Yes. Which has got a liability component as well as an equity component both. So you'll have to segregate what we technically call a split accounting. When there will be a compound financial instrument issued by the company, you'll have to make a split in terms of the liability element and the equity element of the instrument. So how do we do that? Don't worry, we will learn these things on a step-by-step basis. We're also going to learn that if a company issues a compound financial instrument, how does a split accounting apply? How do you segregate that out of the total proceeds of the instruments? What is the liability element and what is the equity element? So, and are they going to be reflected separately in the balance sheet of the company? Yes. So we're getting inquisitive now. We want to look at the balance sheet schedule 3 and have a look at how things are presented. No worry. I'll very soon come to that. But I think let me give you some more permutation combinations as well. If you say that the one component is equity and let's say the other component is FL, so that's same as 2. Well, you can say that the principal component is FL and let's say the interest component is equity or vice versa, whatever. Then also it becomes a compound financial instrument. And it is also possible that both the components become equity. So both the components become equity. If both the components become equity, then it is supposed to be an equity instrument. So moral of the story, what I made a change now to my three-step model, the change number one. The change number one. And what is the change number one? If your mode of payment is different for the two components, you need to run your three-step model twice. You need to first of all decide that what is the principal component? Is it FL equity? And what is the interest or the return component principal, that is interest, the FL or equity? If both the components are FL, the instrument is a financial liability. If one of the component is equity, another is a financial liability, it is a compound financial instrument. And if both the components are equity, then it becomes equity. I know what you're thinking, sir, we need example. I'll now give you some example. And then I'll give you the presentation in terms of Schedule 3. But at this stage, also, let me tell you, by the end of this standard, I'm going to give you a total of 5 charts. I'm going to give you 5 charts in totality, and your life will become jingalala. And these 5 charts are going to be concentrated on different permutations and combinations, and you will be able to easily identify the nature of the instrument. Okay, but that's going to take time, of course. So, but I think first what I need to give you some permutation combinations in order to understand the application of the component discussion which I did with you. So let me, I think, come to the component decisions with you. So let me give you some permutations and combinations. Let's consider this is the principal component, and let's consider this is the return component. So let's consider the principal and return, and I'm going to decide the nature. Think carefully with me. Think carefully with me, and you'll be able to get your answers on this. Let's consider that the principal is going to be discharged by using equity share as a currency note. And let's consider the return is going to be discharged by way of, let's say, cash. So let's consider that the principal is being paid in the form of equity shares, and the cash, the return, the interest and dividend is paid in cash. Now let's consider the permutation combinations very carefully. My issuing company decided to issue a variable number of equity shares. If you decide to issue variable number of equity shares, then it becomes a financial liability. And as far as the return is concerned, it's paid in cash, it's a financial liability. So we can say a variable equity share, one of the components FL, the return is in cash, that's again FL. So FL makes it FL. I hope I'm clear. So when you're going to issue a variable number of equity shares to discharge the principal element, and you're going to pay the return in terms of cash, both the components are financial liability, and the overall instrument becomes a financial liability. Let's take the second permutation combination. And the second permutation combination, you know well in advance that I'm going to issue a fixed number of shares. And the moment I'm going to issue fixed number of shares, then we know that this is an equity instrument. Because if you go to issue fixed number of equity instruments, my step number 3 tells me that it is equity instrument. But as far as the return is concerned, it's a financial liability. So now you know that one of the component is equity instrument and another component is a financial liability. That makes it a compound financial instrument. Wow. So you learned another important input in terms of Index 32, that when an issuer would issue an instrument, it is either a financial liability, or it is either an equity instrument, or it is a compound financial instrument. I hope we made ourselves very clear. Now I think it's time to take you to the inputs in terms of let me share this with you, and let me share the Schedule 3 now. Well, in the study material, you've also been given the Schedule 3, and I think I'd like to connect you to the Schedule 3. Let me just open the Division 2 of Schedule 3 to you and share the inputs to you. Just give me a second. And I think I'm going to take you to the Schedule 3 balance sheet as well. the division 2, which we follow for the purposes of Ind AS, and let's have a look. So let me just share the inputs to you. Let's have a look now on the balance sheet. Now, I think the discussion is going to be incomplete, since we're looking in terms of Ind AS 32, which is a presentation standard. We need to very well understand that how the presentation of this instrument will look like in the balance sheet of the company. So we're going to the liability side. Now, hear me well. You can very clearly see on the liability side of the balance sheet, the heading is equity and liability. So we can very clearly see that there is a heading which is called equity and liability. So this is equity and liability. Now you can see that there is a non-current liabilities in the balance sheet, and it is followed by financial liabilities. So you can see that we're given the financial liabilities and there is a borrowings. So let me put it like this. If a company issues an instrument which is equity instrument, you're going to take it in the equity. You're going to take it in the equity. If a company issues a financial liability, you're going to take it in the liability, non-current liability. You're going to put it in non-current liability. So presentation for an equity instrument is equity. Presentation for a financial liability is liability, non-current liability. So what about compound financial instrument? Well, if there is a compound financial instrument, we'll split in terms of liability and equity. Equity will enter other equity. The equity element will enter the other equity, and the liability portion will enter the financial liability element. We're going to divide and allocate what is the equity component of the instrument. It'll be other equity. And we're going to show the liability component in the borrowings. And I think, let me tell you, you must be already aware of the fact that as far as the other equity is concerned, the other equity is nothing but what we call SOKI, Statement of Changes in Equity. So when you prepare that other equity, can you see that there is a column which is given in other equity? It is called equity component of compound financial instruments. So when a company would issue an equity component of issues a compound financial instruments, you will be able to segregate that this is the equity component of the compound financial instruments. I always call this as tab 1 of SOKI. My SOKI is actually divided into a total of 3 tabs. We'll be coming to the discussion on the 3 tabs very soon. When we come to the financial instrument standard Ind AS 109, I'm going to give you a clarity in terms of how in a practical life area, we segregate this SOKI in terms of a 3-tab situation. So this is, you can say, the tab number 1, because your reserve and surplus is the tab number 2, and the OCI elements is supposed to be a tab number 3. So when you're looking in terms of SOKI, we can say the equity component of the compound financial instrument enters the tab 1 of SOKI, or we can say the other equity. So that was a little connect in terms of how the presentations will take place. So I think let's make a little mention at this stage. So I can definitely say that if an issuer decides that the instrument is equity instrument, what do you do? As far as a presentation in the balance sheet is concerned, it's going to be reflected as a part of the equity. If you say that the company issued an instrument which is a financial liability, it is going to be presented in the balance sheet under liabilities, and that also non-current liabilities borrowings. But if you say that it is a compound financial instrument, it is going to be split. It is going to be split into 2 components. The component which is supposed to be equity will be reflected as a part of the other equity in the balance sheet. And the portion which is supposed to be a liability, that is going to be represented in the financial liability, non-current liability. We're going to do basically what we call a split accounting. So this is what we can say is the presentation. This is what we can say is going to be the presentation in the balance sheet of the company. Okay, so I think my one addition to my three-step model is understood now. So I think let me consolidate and then give you another input, and then we're going to make a draft number 2. So let's, I think, go back. So in this particular case, what I have given you as a new addition in terms of my three-step model is that when you look at obligation in a question, there are two components of obligation, the principal component and the return component. If the company tells you that there are two different modes of payment for the two different components, you need to apply the three-step model for the component-wise. Run it for the principal component, decide FL equity. Run it for the return component, decide principal equity, and then once you decide things, you will be able to decide if one component is FL, another is also FL, it's an FL. If one component is FL, the other is equity, it's compound. But if both components are equity, it becomes an equity instrument, and I gave you two permutation combinations. I said if there is a variable number of equity shares for the principal with a cash in terms of return, it's a financial liability. If it is a fixed number of equity instruments and followed by a cash in terms of return, it becomes a compound financial instrument. Now I'm going to make another addition, a little more amendment so that we are able to get a draft number 2. So let's take it further, step by step, so that we are able to connect with the concept very well. And my piece of advice would be, friends, that please revise this on a daily basis, because it's a little technical subject, but it's a very interesting subject as well, because financial instruments, as I mentioned earlier, is affecting almost like 70-80% of your balance sheet components. Some way or the other, there is a lot of impact of these standards in the balance sheet items, and therefore it is very pertinent to get a good conceptual hold in terms of these topics. Okay, now I'm going to make another amendment. Watch me clear. I'm now making a little amendment to my step number 2. I'm making amendments step by step. I made some amendments to step 1. Now I'm making amendments to step 2. Then I'll be making some amendments to step 3 as well. So I think first, let's give you some amendments on step number 2. In step number 2, I gave you the focus that the mode of payment is either cash or the mode of payment is either equity share. And I said that if it is equity shares, then you go to the step number 3. That's what I gave you, that we're going to go to the step number 3. Now, I'm not concerned with the equity shares at the moment. My focus is in terms of the mode of payment is cash. Now, hear me carefully. Hear me very carefully. I said earlier that if the mode of payment is supposed to be cash, I said it's a financial liability. I said if the mode of payment is cash, I said a financial liability. Now I am making an amendment. I am now making an amendment. Hear me very, very carefully. You see, if I say that the mode of payment is cash, before I say that it's a financial liability, you need to prove it to me that there is an unavoidable obligation to pay cash. Mind the words carefully. If I say, if I say that the mode of payment is cash, it is not enough to say that it's a financial liability. No. You need to prove it to me that there is an unavoidable obligation to pay cash. If there is an unavoidable obligation to pay cash, then it's a financial liability. But if there is an avoidable payment to make a cash payment, then it is equity. Oh. So you mean to say that if the mode of payment is cash, you cannot say it is a financial liability? No. So, but just now, you gave us a permutation combination, and you said if the return is paid in cash, we're saying it's a financial liability. By that time, I had not given you that if this payment is something which is avoidable or unavoidable in nature. So every time you go to the step number 2 and you say that the mode of payment is cash, don't say it's a financial liability. Make your assessment that there is an unavoidable obligation to pay the cash as well, which means that from now onwards, if the mode of payment is cash, you need to see that is it unavoidable? You need to see that is it unavoidable in nature, that you need to pay cash and it is unavoidable in nature. So if you say, yes, it is unavoidable in nature, then I would call it as a financial liability. But if you say it is avoidable, it is not unavoidable in nature, then it's going to be called as an equity instrument. So that particular component of the instrument will become an equity instrument, amended. So I think there are two valuable additions which I made to my three-step model. One of the additions which I made is that you need to evaluate every component of the instrument. And there are two components of the instrument, the principal and the return. You need to make an assessment of each component to decide whether it's a liability or equity. And secondly, when the mode of payment is cash, don't jump to the conclusion. You need to very carefully evaluate whether this portion is something which is avoidable or unavoidable. Now, when I say that it is unavoidable, the question could also give you inputs like saying that it's a mandatory payment. It's a mandatory payment. And when I say it is not unavoidable, it is avoidable in nature, he would give you the terminology that it is discretionary in nature. It is discretionary in nature. Because if you say, if I pay, mind the words, if I pay in cash. The mode of payment is cash, but there is a if I pay. The moment there is a discretion to pay, it means it is avoidable in nature. The moment it is avoidable in nature, it is equity instrument. And if you say that I've got no discretion, but it's mandatory, I have to pay in cash, I have to pay it, I cannot avoid making a payment, then it gives rise to a financial liability element. So can you give us the draft 2 version at this stage, incorporating these two amendments? Yes. Let's, I think, create a draft number 2 to you at this particular stage. So let me create my draft 2. Then we'll start working on the draft 2 and give you some more permutation combinations on this. So let me create my draft number 2. Please note this down. Now this draft is going to overrule my draft number 1. So from now onwards, as we do questions, you're going to consider the draft number 2. So let me give you the 3-step model. I'm considering my 3-step model. And I'm considering my 3-step model. Let me put it in the brackets that I'm giving you a draft number 2. And this is going to overrule my first draft as well. So let's begin with the step number 1. So now you've got to focus in terms of step number 1. When you proceed with the step number 1, you got to put across a question: is there a contractual obligation? You got to put across a question that is there a contractual obligation? So I think my focus is again on the word contractual. I think let's again make a little mention again that when I say that there is a contractual obligation, we're saying it's not legal. That means it's not by virtue of law. If there is an obligation which is triggered by virtue of law, we're not considering that, and it's not constructive. So what we need to consider in this particular case is only that the obligation is contractual in nature. The second focus point now which I've given you is that when I look at the word obligation, you got to consider that there are two components of obligation. You need to consider that there are two components of obligation. So one of the components of obligation is supposed to be the principal component. So this is the focus point when you look at the step number 1, that there are two components of the obligation, the principal and the return. So be careful when you read the question. Your focus should be very clear that there is an obligation. Let's see if the examiner is giving you two components of the obligation, and it should be contractual in nature. So based on this, once you decide that yes, there is an obligation contractual in nature, we would say either a yes or we would say a no. So these two components will only remind you that you should run this three-step twice. This will only give you a recall that please run your three-step model twice. So once you decide that yes, there is a contractual obligation, you got to go to the step number two. You got to go to the step number two. And if you say no, there is no contractual obligation, then this standard is not applicable. I hope I've made myself very clear on the step number one, that there are two main focus points. One is that the obligation has to be contractual in nature. And the second focus is that there are two components of the obligation, the principal and the return. Okay, now this is my step number one. Let's now go to the step number two. Now, when we go to the step number two, we made some amendment to the step number two, also considering the MOP, that is the mode of payment. And I've given you the inputs in terms of the mode of payment, that there are going to be two modes of payment. More or less, you can say it is an exhaustive list of mode of payments. One is that you pay in cash, and one is that you use your equity share as a currency note. So in this particular case, let me remind you back that when you're considering equity share, this is using them as currency note. This is using them as currency notes. So we're using them as currency note. The company is using its own equity shares as a currency note for the purpose. Now, the amendment made is that if it is a payment in cash, don't say it's a financial liability. You got to consider that, is it unavoidable? You need to see that, is it unavoidable in nature? You have to pay. There is an unavoidable obligation to pay. So we can say, yes, it is unavoidable, which means it is mandatory. Yes, it is unavoidable, which means it is mandatory. Or I say, no, it is not unavoidable in nature, which means it is discretionary. That means it is discretionary in nature. So you got to consider that, is it unavoidable? So the moment you say, yes, it is unavoidable, mandatory, this is going to be a financial liability component. And if it is discretionary, then it is going to be called as an equity component of the instrument. Right, I think I made my amendments to the step number one also, and I made my amendments to the step number two also. And if you say equity share, you got to go to the step number three. You got to go to the step number three if the mode of payment is equity shares. Let's now take you to the step number three as well, that if the mode of payment is equity shares, then what do we do? So let's go to the step number three. Step three, of course, remains the same as my draft number one. No changes in terms of step number three. In this particular case, I'm going to conduct what you call the fixed test. So in this particular case, we're going to conduct what you call the fixed test. What you need to do in terms of the fixed test is you need to consider and find out the number of equity shares which will be issued. We're going to find out the number of equity shares which we're going to issue in this case. So you need to decide, are you going to issue a fixed number of equity shares, or are you going to issue a variable number of equity shares? This step, of course, remains the same what I gave you in draft one. So if you identify that the number of equity shares to be issued is fixed, then it is supposed to be equity instrument. And if the number of equity share is variable, then it is supposed to be a financial liability. So this is my draft two version. which is a three-step model, the draft two to decide a financial liability or equity. So let's take a quick recap on this model. And before we go further, I know you must be tired as well, so we'll give you a quick break also after that. And then I think we're going to make some interesting charts with you based on our understanding before we're going to make any amendments to my step number 3. So, model of the story. When you look at a particular question, focus. The step number 1, is there a contractual obligation? When you look at the step number 1, the focus 1, obligation has to be contractual, not by law, but by contract, not constructive in nature. Then the focus number 2 is that there has to be an obligation which has got two components, the principal component and the return component. Okay, so you need to run your three-step model twice. Run it for the principal separately, run it for the return separately, because there are two modes of payment, then run this twice. So once you reach a conclusion that yes, the obligation is contractual in nature, you go to the step number 2. Otherwise, the standard is not applicable. Now we made another amendment. If the mode of payment is cash, watch out that is this unavoidable or not. We can't say that if it is cash, it is liability. If you say that there is a mode of payment cash, C, is it mandatory? Financial liability. C, is it discretionary? Equity. And if you consider the mode of payment is equity shares, go to step 3. And in step number 3, you need to conduct simply what you call a fixed test. So if you say the number of equity shares is fixed, it is equity instrument. If you say it is variable, then it becomes a financial liability. I guess so far so good. I hope, I trust that you've got the concept so far at this stage. So I think at this stage, we'll also like to give you a little break as well. So I think we're just going to take a 10-12 minutes break. I think it's almost like 8:42, 42, 43. So I think we can catch you another 10-12 minutes time, and then we start the journey back. So we'll take a break, friends, now, and I join you back in 10 to 12 minutes time. Welcome back, friends. So, I guess you had a relaxation of mind as well. I think it's equally important to get a little mental rest and keep learning things. So, I think let's just, I think, now make some charts with you. Having understood the three-step model which I gave you, and I gave you the inputs in terms of, I think, let me share the screen once again. And I've given you the inputs regarding the three-step model. And as I said, now I'm going to basically create some charts with you based on our understanding what we've got on the three-step model. I'll basically give you a total of 5 charts in totality. But before, right now, I'll be able to give you only 3 charts. And in these 3 charts, I'll tell you what I'm going to consider. The first chart I'm going to consider is where the mode of payment is just cash. The second chart which I'm going to consider is where the mode of payment is just equity shares. And a third chart where I'm going to consider where the mode of payment is both cash as well as equity share. So to give you a clarity of thought regarding the different permutation combinations which could arise, we're going to create 3 charts to begin with. So one is where the mode of payment is cash, one is the mode of payment is equity share, and one is where the mode of payment is cash and equity shares both. Then there will be 2 more charts coming in. Now, what are those 2 charts going to be? I'll explain that after the 3 charts to you. So let's start working on the 3 charts with you. So that's interesting. So you got a 3-step model and you've got 3 charts based on the 3-step model. Yes. So that's how, I picked up the standard. And when I looked into the standard, I found that it's a very easy way of cracking the standard. When you break it down into smaller components, you're able to get a good grasp on the subject. So let's begin the journey now and let's make a chart number 1 to you. You can start noting it down. So I'm looking at the chart number 1. In the chart number 1, I'm considering the mode of payment is, let's say, cash. So I'm considering the mode of payment, let's say cash, only cash, whether it is for the principal or whether it is for the return component. I'm considering that we're going to make a payment totally in terms of cash. So let's consider 3 columns. One is the principal component, and one is the return component. And based on this, we're going to decide the nature of the instrument. So watch the permutation combinations carefully and try that if you can answer them well. The first is that I am considering the principal is redeemable in nature. I'm considering the principal is redeemable in nature. Now let's understand, if I say it's redeemable in nature, you've decided a pre-decided date when the principal is going to be paid in cash. Remember when I said that there is a payment in terms of cash, it doesn't mean that it is supposed to be a financial liability. What is important is to consider that there is an unavoidable obligation to pay. So when you say that it is redeemable in nature, there is a predetermined date when you're going to make the principal payment. So can I say that would make this component financial liability? Similarly, if I look at the return, let me consider that there is an interest or a dividend which is going to be paid on a mandatory basis. So the moment I say that it's a mandatory basis, which means there is an unavoidable obligation to pay the return as well. So this component will also become a financial liability. So I think it's needless to mention now that if both the components are financial liability, then the overall instrument also is a financial liability. So I think you can watch this combination 1 very carefully. It's redeemable. So there is a predetermined date when you're going to make this payment. It's an unavoidable obligation to pay, followed by a mandatory return. Now let's create some more permutation combinations to you. No worries, we'll pick up some questions from the study material also with you. After these 3 charts are done, we'll make a walkthrough with some illustrations to you. Okay, let's take the next combination that it is a redeemable principal. And it is supposed to be, let's say, a discretionary return. Let's say it is followed by a discretionary return in terms of interest or in terms of the dividend. Now let's have a look. I think it goes without saying as the first case that a redeemable instrument would mean that it is supposed to be a financial liability component. But when you say that there's a discretion, the return is paid in cash, but there is a avoidable obligation to pay. It's discretionary, so that would make it as equity. So when you look at the two components, one is FL and one is equity, then we can say it becomes a compound financial instrument in this case. Okay, so that was a second combination, redeemable with mandatory and redeemable with discretionary. Let's take another permutation combination with you. Now, this time I am considering that the principal is, let's say, irredeemable in nature. So I'm considering the instrument is irredeemable in nature, which means it is perpetual. Irredeemable instruments are also called perpetual instruments, in fact. Now, when I say it is irredeemable, that means that the entity, the issuing entity, has got no obligation to pay because it's irredeemable. So they're not fixing any pre-decided date when they're going to make a payment. So it's going to be an equity component in this case. Followed by, let's say there is a mandatory return in the form of interest, or let's say in the form of dividends on this instrument. So we would say if it is irredeemable, there is an avoidable obligation. So we would call this as equity component. Mandatory is going to be financial liability because you've got an unavoidable obligation to pay. So equity plus financial liability, that's going to make it a compound financial instrument. So the moment a company issues an irredeemable instrument, there is an avoidable obligation to pay cash for the principal. And mandatory means that it's a financial liability. So you can see, as we started with the standard, we said, that if there is an obligation where the mode of payment is cash, it's financial liability. Now, I think we've understood some more inputs on that. That's simply saying that there is an obligation to pay cash does not make it a financial liability. You need to consider that the payment is something which is unavoidable in nature, redeemable for the principal, mandatory for the return component, then only it becomes a financial liability. Let's look at another permutation combination as well. And I think it seems to be quite an exhaustive permutation combinations for understanding, I guess. So let's now consider that it is irredeemable instrument. And there is, let's say, a discretion in terms of payment of return. I think now you would have well understood and you can easily take a call that if it is irredeemable in nature, it would mean equity component. And if it is discretionary in nature, then also it is equity component. So if we add equity plus equity, this is going to be called as an equity instrument in this case. So you can see that I've taken all the four permutation combination, and trust me, I think if the mode of payment is going to be cash, I don't see any other permutation combination coming into play because I've taken redeemable on one hand, followed with a combination of mandatory and discretionary. I've taken irredeemable on the other hand, followed by a mandatory and discretionary. A comprehensive permutation combinations for the chart number 1 when the mode of payment is cash. I hope you've got the complete picture on this. Okay, so I think let's take the journey forward. So this is my chart number 1. And in terms of the chart number 1, we are looking at the mode of payment is cash. The mode of payment is cash, whether it is for the principal or the return. Now, I think let's take you to the next chart number. And I think I've already done 2 illustrations with you, which were totally devoted to the chart number 2 when the mode of payment was supposed to be based on equity share. Here, it would be a really good exercise, which you can also try. That, once we have done all these charts, pick up the questions from the study material and from the RTPs, MTPs and all, and you could easily relate them. And, you could relate them to the charts that which combinations are falling in which category. So when you're going to revise things at the end stage, it'll become a very easy exercise because each of your charts will be well supported with the illustrations which are given in the study material, as well as the past examination papers or RTPs and MTPs, or maybe a few questions from the education material. Though as of now, there is no education material on financial instruments, but there are a couple of other standards where education material has been issued. Okay, I think let's now go on to the second chart with you. So I am now going to the chart number 2. And I think if you're able to understand these charts, then I think your concept is working very well, I think. Now, in this chart number 2, I am considering the mode of payment, and I'm considering the mode of payment to be equity shares only. So whether it's the principal or whether it is the return component, I am considering that we are making a mode of payment in terms of equity share. Now, very careful. The moment you say that the mode of payment is equity share, what is important is that you need to go to the step number 3 and you need to apply a fixed test. Because in this particular case, if the mode of payment was cash, the only thing which we're applying is the unavoidable criteria. So you can say that if the mode of payment is cash, you've got a test which is testing the unavoidable levels. And if the mode of payment is equity shares, you need to test the number is fixed or variable in number. So we need to apply the fixed test and see is the number of equity shares to be given is fixed or variable in number. So I think I see only 2 permutation combinations happening in this case. I would consider that if you compound the principal at a given rate of interest for n number of years, if you compound the principal at a given rate of interest for n number of years, remember that illustration 15? So we divided by the fair value of the shares at the time of issue of that instrument. Now, just look at this concept and see, is the number fixed or variable? When you divide the numerator, in this case, by the fair value at the time of issue, you pre-decided the number. Because you took the fair value at the time of issue of the instrument, you pre-decided the number. So the number of shares to be issued is fixed in number. And the moment it is fixed in number, we can definitely say that it becomes an equity instrument. The other combination, which you remember, was illustration 16. So this was more like illustration number 15 of the study material. And this was more or less like the illustration number 16 of the study material, which I'm going to give you. So I think the chart number 2 was very well covered by us when I made the draft 1 itself. Now here you're going to consider the principal, and it's going to be compounded at a given rate of interest for n number of years. And you're going to divide it by the fair value, let's say on the rate of conversion. So not at the time of issue of the instrument, but at the time when the conversion would take place. So in this case, since you're going to consider the fair value on the conversion stage, we can say the number is not pre-decided. It's going to fluctuate. It's going to be variable in number. And if the number is going to be variable, then I think we know that this is going to be a financial liability in this case. And I think only these 2 permutation combinations can come if the mode of payment is equity share, because the company is issuing equity shares to settle both the obligation. I know what you're thinking, sir. If I am making only the principal payment in equity share, I'm not paying the interest in equity shares. Don't worry, if you're going to make a blend in terms of things, my chart number 3 would cover that. So yes, indirectly, in my chart number 2, I am working with the inputs that I am considering that both the components are certainly being paid. So you can indirectly say that there is a mandatory payment both of the principal as well as in terms of the return element. I'm not considering a discretionary element in terms of the return. So that will get covered in chart number 3. So I hope my chart number 2 is also pretty clear indeed, where the mode of payment was just equity shares for both the principal and the interest. Now I think we need to go to another chart number 3. And in the chart number 3, I'm going to take a mixed blend. So I'm going to take my chart number 3, and here I'm going to take a mixed blend in terms of things. So here I'm going to consider the mode of payment, and the mode of payment, I'm considering both equity shares as well as cash. So I think now you know this very well. I think if you've understood things so far, you can easily relate that if the mode of payment is equity share, the focus is the fixed test. That are you going to issue fixed or variable share? And if the mode of payment is cash, you're looking at the unavoidable test. That is the payment going to be unavoidable or not? So I think let's do one thing. Let's, I think, consider 3 columns now. One is the principal, and one is the return, And let's consider the nature of the instrument. Now watch this permutation combinations carefully. I'm going to create almost all kinds of permutation combinations which could arise. Let's consider that the mode of payment for the equity share is going to be mode of payment for the principal is equity share. And let's consider the mode of payment for the return is cash. So we know that when you're considering equity shares, at the back of the mind, you know, you're conducting a fixed test. And when you're considering the mode of payment cash, you're conducting the unavoidable test, right? So let's be very careful on the agenda. So let's begin the permutation combinations. Now let's consider the first one, that the principal is going to be paid in variable number of equity shares. And let's consider the return is going to be paid, which is mandatory. So let's consider that there is a mandatory return and there is a variable equity shares to pay off the principal. Now, if you consider that there is a variable number of equity shares, it becomes a financial liability. You're running the three-step model, and separately for the principal, that it's variable number financial liability. And if it is mandatory, it is again financial liability, unavoidable obligation to pay cash. So when you add the two components, it becomes a financial liability, right? I guess pretty clear. Variable number of equity shares is FL. Mandatory payment in return in cash is FL. Both the components are FL. That makes it FL. Let's, I think, consider more combinations. So let's now consider that there is, let's say, variable number of equity shares and followed by, let's say, a discretionary return. Let's say there is a discretionary return. Now, the moment you say that it is a variable number of equity share, that component becomes a financial liability. And the moment you say it's discretionary, it gives right to equity component in the instrument. So now one component is FL, another component is equity. So you know that this is going to become a compound financial instrument. So one of the components is variable, that's financial liability. Another component is discretionary, that makes it a compound financial instrument. Wow. Now you would see my thought process is working very clear. And I think if you're able to catch me, then you would know that what is my thought process, that I'm taking this as variable, followed by a combination of mandatory and discretionary. Then I think you can definitely predict in terms of my third combination and in terms of the fourth combination, and you can make predictions. If you're able to make predictions along with my thought process, I think we are going perfect indeed. So let's take a combination number 3 now. Let's say the number of equity shares is fixed in number, and let's say we are considering that there is a mandatory return. So there is a fixed number of equity shares for the principal element, and there is unavoidable obligation to pay in terms of the return component. So this fixed means it is equity instrument, equity component, and mandatory is going to be a financial liability. I think one component equity, another component financial liability makes it a compound financial instrument again. Great. Let's now consider a fourth permutation combination as well. And I think that seems to be quite an exhaustive list of permutation combinations. So let's now consider that this is fixed number of shares and followed by a discretionary return. So there is a fixed number of shares followed with a discretionary return. So in this case, it's a fixed number of shares which gives rise to equity component, and a discretionary element is avoidable obligation to pay cash. So both elements are equity, and that's going to make the instrument as equity instrument in nature. So you can see that again I've taken the combination fixed followed by mandatory and discretionary in nature. So, you know, this gives us a little edge in terms of a thought process, because we're able to look into various permutation combinations before even, you know, we're going to pick up questions. So I think now, as I promised, I've given you a total of 3 charts already. The chart 4 and chart 5 is still pending because I'm yet to do the discussion based on that. But I think now we can certainly consolidate the picture in mind that when you're looking at the 3-step model, there are 3 different kinds of permutation combinations arising on a chart, where the mode of payment is completely cash. you cannot say it's a financial liability. That's what my chart number 1 is telling me. That if the mode of payment is cash, you cannot say it's a financial liability, because in step number 2, I made it very clear that if there is a mode of payment cash, you need to consider it is mandatory or discretionary. So for the principle, I didn't use the word mandatory. For the principle, I use the word redeemable. Because when I say redeemable, it indicates mandatory redemption. Because if it is redeemable, there is already a pre-decided date when the issuing entity is obliged to pay the principal money back. So for the principal, we're using the word redeemable, irredeemable, and for the return element, we're using mandatory and discretionary. So this is when the mode of payment is cash. The second chart which we focused on was a mode of payment equity share, where of course I was assuming that the company is definitely going to pay both the principal and the interest. So there is no avoidable obligations to pay. There is an unavoidable obligations to pay both the components, the principal and the return element. So either you land up paying a fixed number or a variable number, because if the mode of payment is just equity share, what is there in the mind is the fixed test. So the chart number 1 focuses on the unavoidable test, and the chart number 2 focuses on the fixed test. And then in terms of the chart number 3, we took a blend of both the mode of payments, the cash and the equity share. And wherein we said very clearly that if I'm looking at the principal, I'm looking at the fixed test, fixed or variable share. And for the cash component return, I'm looking at the unavoidable test, mandatory or discretionary. And accordingly, the permutation combinations are decided. So far, so good. But I think now we should do some questions with you from the study material as well. So I'm going to do a few selected questions with you from the study mat as well. So I think I'm going to now take you to the unit number 1. This is the study material where I'm going to the unit number 1, and I'm going to pick up a few questions to elaborate. Let me just remind you that I am looking at the financial liability and equity instrument, and not yet discussed the financial asset part with you. So my focus is typically on a financial liability and equity instrument. Now there is a simple example number 2, which is given in the study material in unit number 1. And I think we'll just quickly run through the inputs and see whether it is a financial liability or not. Now, we are given examples, loan payable. Now, if a company has got a loans payable, is there a contractual obligation? Step number 1, yes. There is a contractual obligation to pay. What is the mode of payment? I assume it's cash. Therefore, it is financial liability. Sir, but you said that if there is an obligation and the mode of payment is cash, not necessarily that it is a financial liability. I am, of course, assuming that there is an unavoidable obligation to pay in all these examples. Trade and other payables is again a financial liability with the same logic. Bills payable is again a financial liability with the same logic. The deposit received is again a financial liability with the same logic. Because when you're looking at the deposit received, then we are saying that we have an obligation to pay the deposit back. So there is a financial liability. Mandatorily redeemable preference share. I think the word mandatorily redeemable preference share indicates an unavoidable obligation to pay. And that's again a financial liability. If there is a financial guarantee which is given, this is again a financial liability. But you would say, sir, the financial guarantee may or may not get triggered. Because in this particular case, let's say a company has taken a loan. If a company has taken a loan and in this particular case, he fails to pay the loan to the banker, my company might have issued a guarantee to the bankers and told them that if he doesn't pay, that I'm liable to pay. It is undoubtedly considered as a financial liability, because if the liability triggers, I've got an unavoidable obligation to pay, right? So I'm saying that I have an unavoidable obligation because I cannot avoid that obligation in any case. I understand that the guarantee may or may not trigger because of the fact that the other person fails to pay. If he fails to pay the money to the bank, my liability arises and I've got an unavoidable obligation to pay at that stage. But if the other person pays the money, the liability doesn't arise. But I have unavoidable obligations that makes it a financial liability. Okay, so these are a few examples to understand the concept of financial liability. And I guess now let's consider a few more questions to you. So that was an example chart. Let me now take you to some permutation combinations on this. Now watch this. We're now looking at the illustration number 6. And now you're going to see that we're going to apply a 3-step model very carefully. So I think I'll give you the inputs on my 3-step model as well. I think even if you read the heading of that illustration and I think your concepts are working very good, I think you will be able to take a call whether it's a financial liability or equity. But don't worry, we're going to read the facts of the case. Let me read. It says Silver issued irredeemable preference share. I think I'm very clear that it is irredeemable. Principal element is irredeemable. With a face value of 10 at a premium of 90, the shares carry a dividend of 8% per annum. However, the dividend is paid only when Silver declares a dividend on equity share. You told the preference shareholder that once I pay the dividend on equity share, I will give you dividend as well. Now he is feeling happy. The preference shareholder is feeling happy that, the company is telling me that if I pay the equity shareholder, boss, I'll give you the dividend as well. Now see what they might have told the equity shareholder. They might have told the equity shareholder that I have got no obligation to pay dividends to you. So if the company has got no obligation to pay the dividend to equity, and you're telling the preference also that if I pay them, then I pay you, I think it becomes discretionary to that extent. So being an irredeemable instrument, there is one. And being a case where there is a discretionary dividend, there is two. I think both the components in this case is something which is equity element in nature. And when it is equity element in nature, then we can say that this instrument definitely becomes an equity instrument in nature. So I'm not reading the entire answer, but you can see at the end, it is very clearly given that the preference share meets the definition of equity instrument. So I think I'll just like to map you in my 3-step model if we were to do that. So I guess if I map up this illustration number 2, and mind you, sorry, not illustration number 2, this is illustration number 6. This is in unit number 1. So this is the study material in unit number 1. Earlier, I did the illustration in unit number 3. So this is unit number 1, illustration number 6. So what you need to do very carefully, you can, I think, first of all, explain that there is a contractual obligation, correct? Then you go to the mode of payment. In this case, the mode of payment is cash. So we can certainly say that there is a principal element. Look at run this 3-step model twice for the principal component and for the return component. And you can very easily reach a conclusion on the nature of the instrument. So in this case, you can see the mode of payment is cash. The mode of payment is certainly cash. I think let me make a mention that the mode of payment is cash, but we're looking at the fact that this is irredeemable in nature. And we're looking at the fact that the return is discretionary in nature. So if it is irredeemable, it gives rise to equity component. If it is discretionary in nature, it gives rise to equity component. So equity plus equity is going to make it an equity instrument in nature. I know now, many of you must be having a very important question as well. So in the examination, can we go and answer things on a 3-step model? Well, I think there is no harm in answering in a step-by-step approach, but at least you're able to elaborate the logic in terms of what you're saying. Because at the end of the day, the 3-step model that we are doing is only giving you the essence of the definition of financial liability. So I think even if you make that chart in terms of telling the examiner very clearly that there is a contractual obligation one, the mode of payment is cash, and then you tell him about the parameters that there is a unavoidable obligation to pay both the principal and the return. Therefore, each component of the instrument becomes equity. It is an equity instrument. Even if you look at the answer in the institute module, well, they've given the same inputs. If you see, they've very clearly said that there are two characteristics of the preference share. One is the dividend and one is irredeemable. And then they've quoted the definition of the equity instrument, because at the end of the day, you're going to conclude that it's equity instrument. So then they gave the logic as well that there is no contractual obligation to pay cash since it is irredeemable. And the dividend is payable only if it declares an equity share. That makes it discretionary in nature. So they've got an unconditional right to avoid payment on cash. Therefore, the conclusion comes it's equity instrument. It's the same thing, but I'm just, broken it into a various step-by-step model. Okay, so that's great. I think let's have a look at more inputs now. Let's, look at illustration number 7 further to get the concepts. Let's read illustration 7. It says A is investing in what we technically call CCPS. The word CCPS is very commonly used in a practical areas. Like, if you go to the practical world, you'll hear the terms like, we call this as, let's say, for example, OCD, optionally convertible debenture. We hear the terms like CCD. It's called a compulsory convertible debenture. So a very common kind of terminology. And like, for example, we've got that CCPS, we've got CCD. Then we've got OCPS, optionally convertible preference shares, and we've got something what we call OCD. Don't worry, you're going to get a little familiar with these terms as well, because my chart number 4 and chart number 5, typically my chart number 5 is still pending. And with that, you'll be able to understand, that there are different kind of instruments. A company would issue a CCPS, compulsory convertible preference share. CCD, compulsory convertible debenture. Then you can have an OCPS that is called optionally convertible preference share. OCD, optionally convertible debenture. The terms are very simple. Then you've got something like MCD, mandatorily convertible debenture. Then we've got something like MCPS, mandatorily convertible preference share. So the company might issue, instruments which are mandatorily convertible, or they are supposed to be optionally convertible. So we call them as CC or MC, whatever. Mandatory convertible, compulsory convertible, one and the same thing. They can also be PCD, partially convertible debenture, partially convertible preference shares. So you're going to see all the terminology coming in once we make more progress in this standard. Okay, let's come back to the illustration 7. So it says A invest in a compulsory convertible preference share issued by a subsidiary, 1,000 rupees each with a face value 10 and a premium which is 990. Under the terms of the instrument, each CCPS is compulsorily convertible into one equity share. Mind it. Each preference share is convertible into one equity share, 1:1, fixed number of equity shares. And then it says such CCPS carries a dividend which is 12% payable only when it is declared at the discretion of B. The dividend is discretionary. And as far as the conversion is concerned, it is in fixed number of shares. You need to evaluate the definition of financial instrument. I think you know that. Let me still, take you and do my input. So let's look at the illustration number 7. Here again, we're looking at both the components of the instrument. So let's see what are the inputs given. So as far as the principal element is concerned, this is going to be by way of conversion into fixed number. So the moment it is a fixed number, I would say this becomes an equity component. And as far as the dividend is concerned, it is discretion of the issuer. And the moment it is discretionary, it becomes equity. So this is, you can say something which is based on my chart number 3. So this is indirectly based on my chart number 3. This is indirectly based on my chart number 2. Because when I gave you the mode of payment is just cash, sorry, not chart number 2, chart number 1. So mode of payment is cash, it was chart number 1. And this is a mode of payment where you are making a payment both in equity as well as cash. So you can notice now that I have done a couple of illustrations where we have covered examples on chart 1 also, on 2 also, and 3 also. The illustration 15 and 16, which I did in the unit number 3, was devoted to the chart number 2. The illustration 6 and 7, which I'm currently doing with you, is based on the chart number 1 and 3. Wow, I think I've done a bit of your homework as well, giving you the relationship, which question relates to which particular chart. By the way, if both the components are equity, it undoubtedly becomes an equity instrument. So I think that's pretty easy now to decide. I think you would easily now decide. So if I just take you to the conclusion in the end, it says it meets the definition of equity instrument and will be classified as such. Let's have a look at more questions. I hope you're getting a confidence level as well. Because once you know the concept very well, it's easy to do the question. I sometimes see a little reverse psychology, what certain students have. Generally what they tend to do is practice, keep practicing questions. By the end of it, you might get the concept. That's the output. The input is in terms of doing a couple of questions and getting the output, which may or may not be achievable, then you get the concept. Trust me, your input should always be a concept. And once you're able to do the concept, you'll certainly get the output in terms of good marks. Undoubtedly. Okay, let's have a look at illustration number 8 now in this case. It says Target Limited took a borrowing from Z for 10 lakh. And Z enters into an arrangement with Target for settlement of the loan against issue of certain number of equity shares of Target. It says that the company Z enters into an arrangement with Target for settlement of the loan against issue of certain number of equity share. So one thing is very clear, that the mode of payment is equity share. For this purpose, the fair value per share to determine the total number of equity shares to be issued shall be determined based on the market price of the share at a future date upon settlement of the contract. I think this is my chart number 2, where the equity share is being used as a mode of payment, and you will give as many equity share so that you are able to pay that 10 lakh rupees back. So we're taking the fair value on the date of conversion, on the date of settlement. Evaluate the definition. I think undoubtedly it becomes a financial liability. So I think if I connect you to the illustration 8, I guess now we are looking at all the permutation combinations. So this question is based on my chart number 2 technically, where my mode of payment is supposed to be equity shares. And he's very clearly said that whatever is the amount you need to pay, this will be divided by the fair value, which is at the time of settlement. Since you're going to consider the fair value at the date of settlement, you are going to issue a total of variable number of shares. And if you're going to issue a variable number of shares, it is undoubtedly financial liability. If you see, the study material is the place which is giving you such a wonderful understanding. If you notice that what they've done in a complete row, they've given you illustration number 6 based on chart 1. They've given you illustration number 7 based on chart 3. And they've given you an illustration number 8, which is based on chart number 2. Can you see that? That all 3 illustrations in a row is testing you if the mode of payment is equity, if the mode of payment is cash, if it is a blend of equity as well as cash. And I think once we got the clear-cut understanding, we are able to crack the question very well. Okay, so I hope we are getting confidence. But you should please revise this as well, because these things need a little continuous revision in terms of things as well. Okay, so these were a few questions. I think I've got some more questions coming in. I'll now like to take you to some more questions. And I think specifically, I want to first look at one particular question. Okay, let me just see if I've got more questions. Otherwise, we can give you some questions to practice as well. Yes, I've got some more questions with you. Okay, no, these one we'll do later, not at this stage. Okay, let's have a few more questions, I think, to begin with. This is now in unit number 3. I'm now again switching over to the unit number 3. So let me just take you further. I was on unit 1 illustrations now. So I'll give you the page number reference. Now I am back to the unit 3, friends. Just be a little careful that I am now back on the unit number 3 of the study material. And in this, I'm looking at the illustration 1 on page number 12.91. Let me mention the page. So this is on page number 12.91. I'm looking at the illustration number 1. So a few illustrations I've covered in the unit number 1, a few illustrations on the unit number 3. So what about the unit number 2? Don't worry, we'll be coming to the unit 2 also later. That's more to do with the Index 109. We are still on Index 32. Okay, let's have a read now. It says A, that is the brackets, it says issuer issues preference shares to B, which is the holder. The preference shares are redeemable at the end of 10 years from the date of issue. It's a redemption, redeemable in nature. You know what you need to think. Then it says the holder is entitled to a cumulative dividend of 15%. A cumulative dividend means that in case the company is unable to pay a dividend in a particular year, it will get carried forward to be paid later. So there is an unavoidable obligation to pay. So it's redeemable in nature and it is accumulative, which makes it mandatory in nature. And then he adds on, the rate of dividend is commensurate with the credit risk profile of the issuer. So basically, I am paying the rate which I am supposed to pay considering my credit risk profile. We'll talk of this a little later because credit risk is something which we'll discuss in financial instruments. Typically, when we come to the concept of creating a provisioning, what we call an expected credit loss model. All that later. Don't even think right now. Examine the nature of the financial instrument. Okay, so I think let me just come back to my chart, in this case, illustration 1, and let's get the input. So one thing is pretty clear in this case, that the mode of payment is cash again. So it is technically, if you ask me, based on my chart number 1, it is based on the chart number 1 because the mode of payment is cash. So we're looking at the principal element and we're looking at the return element, the return component, and on that basis, we will decide the nature of the instrument. So I think let's make the analysis. We given it's redeemable in nature and it's cumulative dividends. So redeemable, principal, and it is cumulative makes it mandatory in nature. So I think if it is redeemable, it's a financial liability. And if it is mandatory, it makes it again financial liability. So both the components are financial liability. So the nature of the instrument is undoubtedly a financial liability. Super. So that is illustration 1. I think let's go on to the further inputs with you. Let's have a look at illustration 2. And I would ask you, if your funders are going too strong, why don't you just read the heading of that illustration and take a call? Redeemable debenture, discretionary dividend. I think you can decide. If your funders are going too good, you can easily decide redeemable makes it FL. Discretionary dividend makes it equity component. So FL plus equity is supposed to be a compound financial instrument. Wow. If you've been able to answer this, give a pat to yourself that you're going good. That's wonderful indeed. So let's, I think, still read the illustration with you. It says X company issues debentures to Y, and those debentures are redeemable at the end of 10 years from the date of issue. The interest is 15% payable at the discretion of the issuer, and the rate of interest is commensurate with the credit risk profile of the issuer. So we can very clearly say that it's redeemable and discretionary. So illustration number 2. Let's, I think, lay down the parameters in terms of principal. So the principal we are given is redeemable in nature. So this is redeemable in nature. And it is supposed to be a discretionary return. This is again based on my chart number 1, where the mode of payment is cash. So redeemable would make it financial liability. And discretionary will give rise to equity component in the instrument. So one component is FL, another component is equity, that's going to make it a compound financial instrument. Wow. So this was the illustration number 2. Okay, let's try another one as well. Let's consider the illustration number 3. The illustration number 3 is telling us that P company takes a loan from Q company, the holder, and the loan is perpetual. I think even if you read the heading, it's perpetual loan, and it says mandatory interest. So there is a perpetual loan means irredeemable principal, and there is a mandatory interest. So one component is going to be equity perpetual, another component is FL, is going to make it a compound financial instrument. But there is something more which I need to discuss about this perpetual loan, but not today. There is something more which I need to discuss about this perpetual loan with a mandatory interest, which is there in my chart number 1 as well, but not today. But remember, in the next session, of course, I'm going to discuss with you the concept of a perpetual loan with a mandatory interest, because there is something very interesting which is given in the standard. If you look at the appendix B of the standard text index 32, there is a very interesting example. And this example which is given is based on that appendix which is given in the appendix B of index 32. So we're going to talk of this a little later, not today. A time will come. So right now we are saying that there is a perpetual loan with a mandatory interest. So P company takes a loan from Q. The loan is perpetual and entitles the holder to a fixed interest rate of 8%, which is mandatory. So I think if I come to the illustration number 3, let me look at the permutation combinations now in illustration number 3. So we've got the principal element and we've got the interest, that is the return element, on the basis of which we're going to decide the nature of the instrument. So as far as the principal is concerned, we have very clearly given that it is irredeemable in nature, and the return is supposed to be mandatory in nature. So this is again based on my chart number 1, because the mode of payment is, of course, we're taking cash. So this is based on my chart number 1. So at the end of the day, do correlate the illustrations related to chart 1, chart 2, and chart 3. Okay, so when I say it is irredeemable in nature, that makes it a equity component. And the moment you say it's mandatory in nature, that makes it a financial liability component. So equity plus a financial liability is going to make it a compound financial instrument in this case. Great. So that is illustration number 3. And now a little clarification. The illustration number 4 is not supposed to be a question which is elaborating you that whether it's a liability or whether it's an equity instrument. This illustration is elaborating just a little clarification. The question what comes to the mind is, many people at time ask a question, sir, my company has got an unavoidable obligation to pay cash, but I am not in a position to pay cash. Is my inability to pay a cash or any kind of restriction on me to pay a cash, would it make any differences in the analysis? Mind it carefully what I'm telling you. The question is that you've got an unavoidable obligation to pay. So if you've got an unavoidable obligation to pay, if you are not in a position to pay, or if there is a legal restriction on the part of the company to pay in cash, would it negate the assessment? Would it mean that it's not a financial liability? No, this will not affect my analysis. The inability of the company to pay, the fact that there is going to be any restrictions on the company to pay cash does not make any impact on my analysis. Your unavoidable obligation to pay cash is going to conclude that it is undoubtedly a financial liability. Let's have a look at illustration 4, which is based on this clarification. It says, does the lack to access to foreign currency or the need to obtain approval for payment from a regulatory authority will lead to a contractual obligation? Yes. The standard has made it very clear that the lack to foreign currency access or the need to obtain approval for payments, it does not negate the contractual obligation or the holder's right under the instrument. Now, you would also say that if the holder says that I've got a right to receive, well, he's got a right to receive. If he doesn't get that money, He could do an impairment testing. But that doesn't negate the fact that it's not a financial asset. That doesn't negate the fact that it's not a contractual obligation for the issuer. So that was illustration 4, just a clarification in between. Okay, let's have a look further on illustration 5. No, we are not looking at illustration 5 at the moment. But why, sir? Well, we are not looking at this illustration because it is a case of OCPS. And I'm yet to explain you the concept of OCPS. I have only covered the aspect of CC, compulsorily convertible preference shares or debenture, or you can say MC, mandatorily convertible preference shares and debenture. I'm yet to discuss the concept of what we call optionally convertible instruments in nature. Okay, so this will be later, and then illustration 6 later. Okay, now I think I am in a comfortable position to, I think, summarize things with you and then give you a test. You know what we'll generally do, of course, also. Towards the end of our sessions, almost in the last 15-20 minutes at the max, what we're going to do, we are going to first make a little mind map, because I'm in a good or bad habit, whatever you call it. You know what I do? I take my learnings and the takeaways on those learnings at the end of each class. I would also advise you that whenever you learn, you should definitely have some takeaways from your learning. So what are the key agendas we have learned for the day? And then a small little testing with a little MCQ kind of questions, for which I can, maybe give you the answer later. But I'll give you around a 5 questionnaire, a small kind of MCQs, just true, false, or choosing the correct options, wherein you can decide the things. Answers for these kind of MCQs will, of course, be shared to you later. We'll discuss them maybe at the beginning of the next session, because this is a longer topic. And we're going to go on with this for almost like 9 sessions with you, because it's a very big and a complex topic indeed. And as I said, very important from the examination point of view as well. And my piece of advice would also be, try to catch up with the lectures. Don't look into the lecture number 1. You'll say, I know this, let me go to the lecture 2 directly. I would advise that you should go to lecture by lecture in a sequence, because the learning has to be in a very systematic manner. So even if you might be having your concept prior, I think most of you might be learning for the first time. Some of you might be, already having a knowledge base on the subject. But I would still insist that go on a step-by-step learning. Go with a complete sequence of the learning. You'll definitely feel much better indeed. Okay, now I think I am going to make my small little mind mapping before I take you further. I'm yet to make amendments to my step 3. I am not done with the final version of my 3-step model. I'll be making some value additions again in the next session with you. So let me first make a mind map in terms of things. If you want, you can note it down as well. I'm just going to make a little mind map of all the learnings we have done today. Well, I think we've understood one thing, that when you look at a financial instrument, we know that there are 2 parties to the financial instruments. And we know that the parties are called as issuer, and the party is called the holder. The issuer is the party, the entity, which is focusing on the liability side of the balance sheet. And the holder is one who's focusing on the asset side of the balance sheet. So when you're focusing on the liability side of the balance sheet, he needs to take a call. Now, I think we can definitely add on that the instrument is supposed to be a financial liability, or the instrument is supposed to be an equity instrument, or maybe it's a blend of both equity and liability. Earlier, when we started off during the day, I started off with the definition where it said that it can be either a financial liability or an equity instrument. But now I've given you 3 inputs, that it can be a financial liability, it can be an equity instrument, or maybe it's a blend of compound and equity and financial liability, calling it as a compound financial instrument. But the holder, in any case, is always saying one thing only, that it is supposed to be a financial asset for him. So whether it is a financial liability for the issuer, or equity instrument, or a compound financial instrument, the holder only lands up saying that it's a financial asset. Then my entire focus, shifted to the issuer. I said I'm not talking of the holder right now. But we needed to understand the definition of financial liability, which we started looking at. We not needed to understand the definition of equity instruments. So I created a three-step model, and I'm yet to cover the aspect of financial assets. So in order to understand financial instruments, it was important to understand the term FL, which we are understanding, equity instrument, which we are understanding, and financial asset. But we have left the financial assets for the time being. Now, when I am looking at the issuer perspective, I gave you a three-step model. I gave you a three-step model in terms of deciding things, and I made amendments to the three-step model, and still my exposure draft number 2 is there with you. I'm yet to create a final version of my three-step model. Will still, mutate. It's like a COVID kind of model which sees its own mutations. So in terms of the three-step model, I gave you a three-step model out here. And I said your very first focus in terms of things is going to be, you will put across a question that there is a contractual obligation. So there are two key focus words which you need to focus upon. One is that the obligation is contractual in nature, and the other is that there is an obligation. So we very clearly, identified that when I say a contractual obligation, I'm not saying that it is imposed by law. I'm not saying that it is self-imposed. I'm not saying that it is self-imposed as well. It's not by law. It's not constructive in nature. It is something which we can say is contractual in nature. The second is, when you look at the concept of obligation, immediately what should shoot to your mind is that there are two components of the obligation, the principal element, and you can say the return element, which immediately, threw a light on the fact that when you're looking in terms of running this three-step model, specifically if in the question you are given two different modes, even if you're not given two different modes, it doesn't make a difference. Because even if you're given a single mode of payment, but one of the mode is mandatory and one of the mode is discretionary, you need to run it twice. So depending upon the need, you might have to run this three-step model twice, even if the mode of payment is just cash, because one of the components might be mandatory, one of the components might be discretionary. Then we need to go to the second step and look at the mode of payments. And I said, consider that the mode of payment is more or less exhaustive in nature. That we've got either the mode of payment is cash or the mode of payment is in terms of equity share. But in this case, we said that if the mode of payment is cash, we need to consider that is it mandatory or is it discretionary in nature. So if the mode of payment is cash and it is mandatory, then it gives rise to financial liability. But if it is discretionary, it will give rise to equity component. And we said that if it is supposed to be equity shares, you need to go to the step number 3. And in step number 3, we decided that it is a fixed test. So in other words, we can very conveniently say that if the mode of payment is cash, apply the unavoidable test. And if the mode of payment is equity shares, apply the fixed test. C is the number of equity shares issued. Is it fixed in number? Or is the number of equity shares issued variable in number? If you say it is fixed in number, then it's equity instrument. Otherwise, it's going to be a financial liability. And based on this, I supported all this with you, and I gave you a total of 3 charts to you. The chart number 1, where I gave the mode of payment cash. The chart number 2, where I consider the mode of payment equity shares. And the mode number 3, chart number 3, where I took a cash and equity shares blended. I guess all well understood so far, so good. Now, I think what I need to do, I'm going to give you some few questions, MCQs to try. So you can take this and decide a true and false treatment. I'm going to give you 5 questions. I'm not giving you the answers right now. We'll discuss them later. But let's, I think, give you the 5 questions, note it down, get the answers, match them, and then see if you're able to comfortably. Your concepts are going very, very good. So number 1, can I say if there is an obligation by law, it is a financial liability. You need to decide true or false. So if there is an obligation by way of law, I'm making a statement, it is a financial liability. Number two, if mode of payment is cash, it is definitely a financial liability. It is definitely a financial liability. So if the mode of payment is cash, I'm saying it is definitely a financial liability. You need to decide, is it true or false? Wow. Number three, if mode of payment is goods and services, if mode of payment is goods or services, if the mode of payment is goods or services, Ind AS 32 is not applicable. So if the mode of payment is goods or services, Ind AS 32 is not applicable. You just need to decide true or false. Number four, if mode of payment is equity shares, if mode of payment is equity shares, we need to apply fixed test. We need to apply what you call the fixed test. That's a statement where you need to decide true or false. So if the mode of payment is equity shares, the focus is equity shares. Here the focus was goods and services. Accordingly, you decide. And I think another small little question at this end. So I think I'll just take a second. You can note it down. If there is an obligation by law, it is a financial liability. If the mode of payment is cash, it is definitely a financial liability. If the mode of payment is goods and services, Ind AS 32 is not applicable. If the mode of payment is equity shares, we need to apply the fixed test. And I think let's consider if mode of payment is cash, if mode of payment is cash, we need to apply unavoidable test. We need to apply the unavoidable test. Now, this is not a term which is used in the standard, but I think based on our understandings, we're just trying to get the inputs. That if the mode of payment is cash, we need to apply the unavoidable test. So I think there are one or two questions which are slightly overlapping intentionally. You know that I don't want to say that in clear words, but I think you know what is the answer. So these are the 5 MCQs, and you need to just decide a true and false in this. Understand the concepts. We've understood the concepts very well, I guess. And with that understanding, I think you'll be able to easily manage these 5 MCQs as well. I'll be giving you the answers on these particular steps in the next session with you. And in the meantime, you can try this. So we're going to see you in the next session. But my piece of advice before I take a goodbye from you, my piece of advice is, friends, that be very regular with this particular standard. Being a complicated standard, I think we definitely need to, put in our consistent efforts. So be a little consistent in learning, and trust me, if you're consistent in learning from day one on this particular topic, nothing would challenge you in terms of financial instruments. The topic might be technical indeed, but it is far very interesting as well, and very important from the examination point of view, because invariably you would get a weightage of almost around maybe 15 to 20 marks, or maybe more than that in the exam, and which means quite a lot. So I think on that particular note, I will now take leave from you, and I'm going to join you back in the next session. So have a good weekend, and see you next after this in the next class. Thank you so much. Bye-bye, and take care.